Once the spreadsheet opens, enable editing. The first thing I'm going to do is decide on an initial investment amount and enter that in cell D2. In this case, I've used $10,000. Next, I'm going to enter my entry price in cell E8. In this case, 99.46. 99.46 represents a contract value of $2,250 shown in cell E9. In cell G3, I'm going to enter my deposit per contract. At 99.46, the total value of the position is $2,250. I'm trading with more than the contract value, $3,333, to ensure I don't have a margin call or debit balance. In fact, if the position does go against me, I could add positions to cost average my overall entry to more favorable rate and price. The first thing I'm going to do after my trade is set up is check my maximum exposure if this rate went to 0. In cell B2, I've entered 100, representing a rate of 0. This will show in cell C2. At 0, my net loss for all positions would be $6,900 shown in cell E2. My net liquidation value, after all bid-ask spreads and fees, would be $3,100 shown in cell G2. Now let's look at the upside, and let's assume that the Fed is right about the rate they set. And between now and the end of 2016, the Fed funds rate does go up to 1.8%. Enter 98.20 in cell B2. The rate the contract price represents, 1.8%, will show in cell C2. The net profit or loss, after all bid-ask spreads and fees, shows in cell E2, $15,600. The net liquidation value of the initial $10,000 investment shows in cell G2, $25,600. This is just one simple long-term trade that runs over the next 14 and a half months. Between now and December 30th, 2016, we have 10 Federal Open Market Committee meetings. Any hike or statement during the next 10 FOMC meetings could set aggressive momentum in motion with the futures markets pricing in the disclosed Fed expectations. Facts. From the current historic lows near 0, short-term rates can only have a major market move in one direction. The Fed has repeatedly stated where they expect the Fed funds rate and when. The question doesn't seem to be if rates will rise from their current artificial and historic lows, but when and by how much. There's a lot you can do with a market that's trading near 0 and historic lows. Using more sophisticated strategies, you can achieve a far superior return on risk relative to the simple trade we've just reviewed. Using a different trade, a different spreadsheet, in the following example, I'm trading multiple markets and deliveries. My initial investment for this actual trade is $250,000. The first thing I'm going to do is qualify risk. On the spreadsheet, I've entered a value of -1. This will force all the contract prices for all markets and deliveries up to a price of 100, representing a rate of 0. My net loss at 0 would be $57,750, dropping the initial investment value of $250,000 down to $192,250, or a negative 23.10%. Now let's see if the Fed's partially correct about the rate they set. I've entered 0.50 on the spreadsheet, representing an increase in rates of 0.5%. If rates rise by 0.50, my net profit on the position would be $277,875, bringing the liquidation value of the $250,000 initial investment to $527,875, or up 111.15%. Now let's knock it up a notch. I've entered a 1% increase in short-term rates on the spreadsheet. A 1% increase in short-term rates would generate an $861,000 profit on this position, bringing the $250,000 start balance up to $1,111,000, or up 344.4%. I'll conclude with this question. What do you think is the highest return on risk with the greatest probability of occurring? The top end of the Fed funds target range moving from its current historic low of 0.25% up to 0.5%, or within 90% of its 15-year high of 5.5%, for an appreciation in contract value of 100%, or the Standard & Poor 500 moving from its current level of 2006, taking out its old record high of 2,118, and moving all the way up to 4,012 for the same 100% appreciation in contract value.